Joining us now to break down those results and give us his outlook for this year, first on CNBC, Union Pacific CEO and Chair Lance Fritz. Lance, it's great to have you on, as always, on the heels of results. One of the things you talked about on the call was this idea that there's a lot of uncertainty as we enter 2023. Walk me through what that looks like and what that means from the railroad standpoint, given the fact that you do move so many different types of commodities and goods across the U.S. and really through the continent.
Yeah, Morgan, first, thank you very much for hosting me this morning. You're exactly right. Freight railroads in the United States move about 40% of our tonnage of the goods economy. And as Union Pacific looks into next year, our concerns are around housing looking like it's getting a little wobbly. The consumer looks a little wobbly to us. Not sure what's going to be happening in Asia in terms of source of imports, and it's not really clear what demand for those imports will be. You roll that all together, and there's enough storm clouds in industrial production that's expected to be down 0.5 percentage point for us to think, well, we're going to add business. We're doing a great job on business development. We just brought on a large new customer in Schneider in their intermodal business. It's just too early for us to have a finer point on what we expect out of the year than to say we think we're going to exceed industrial production.
Okay. So given that fact, the decline in industrial production, the fact that all the manufacturing data is contracting right now, can you still grow volumes? And if so, where are you seeing pockets of strength?
Yeah, there is a potential to, and the pockets of strength are pretty broad for us. If you start in the bulk commodities, we think coal has some growth upside for us. We didn't meet all the demand last year because of some of our network fluidity issues and a little bit of weather at the tail end of the year. So there's still coal that can support growth. We see some other areas of growth, fertilizer perhaps, maybe in the soda ash world. When you switch over to the industrial products area, metals has been a good market for us. Frac sand is actually a growth market for us right now, year over year. And then you go into premium, and because of the addition of Schneider and our excellent stable of partners that are intermodal marketing companies like Hub, XPO, Knight Swift, and others, we're in really good position to be able to grow inside of the domestic intermodal market. And the easy comps year over year on international intermodal, it's a little bit hard to discern. The comps are a little easier, but consumers are apparently pulling in their horns in terms of buying things. So overall, there are growth opportunities.
And that's exactly where I was going to go with you, because we have seen this really remarkable decrease in freight coming into the U.S., many of those intermodal containers, which are consumer-facing. And on top of that, you have the East Coast, which has taken more and more of those volumes away from the West Coast in recent months, even with here in the New York area, the ports here becoming the #1 port in terms of some of those volumes. Do you expect that some of that flow-through of goods is going to return to the West Coast? And how much are the labor negotiations at the ports impacting this entire conversation?
Yeah, Morgan, there's definitely an opportunity for goods to go back to the West Coast. Some part of it moving out was congestion. That's gone off the ports. And some part was more recently concern about labor negotiation. I understand that those labor negotiations are proceeding. The temperature is relatively low. And the executive directors of both ports in L.A. and Long Beach are expecting to achieve an agreement. I'm not sure exactly when. But we don't need to rely on volume going back to the port from the East Coast or the Gulf Coast. There's a relatively easy comp in the beginning of the year where the owners of the boxes, the big ocean shipping companies, were trying to make those boxes empty this time last year because pricing was so good over the Pacific. And now they're much more prone to allow the box to go inland. That's where we get the opportunity to take it in.
Hey, Lance, I mean, are you framing the year as one in which industrial activity obviously softens, but prices do not? And how treacherous is that scenario if, in fact, operating costs, for example, don't follow the decrease in activity?
Yeah, Carl, our specific guidance for 2023 was that we're going to beat industrial production on the top side, and we're going to price ahead of inflation. We're very confident in both. We anticipate there's unique growth opportunity available to us, both from a business development perspective and the microeconomics of some of our markets. On the pricing side, clearly, truck capacity is loose, and that makes for a more difficult pricing environment. But even in that context, we think there's still enough opportunity, reflecting inflation, reflecting the value that we're providing to our customers, to be able to continue to price in 2023.
Lance, I mean, you've mentioned, though, a number of times, a lot of uncertainty as we begin this year. And I think it'd just be instructive for our viewers. Go through a few of those things. Can you distinguish them from years past in terms of the level of uncertainty as well?
Yeah, so unlike, let's say, the past 3 or 4 years, you've got this dynamic of the Fed raising interest rates very rapidly, which ultimately will destroy demand across markets. And you've got consumers that have been telling us for quite some time that they're concerned, but they've been flush with cash, mostly about transfer payments from the government, but also from a very hot jobs market. So you put those two together, and it does appear that consumers are starting to pull in their horns on goods consumption. They're still consuming at a high rate on experiences and travel and entertainment. And it's just not clear yet exactly what the impact's going to be of the Fed interest rate increases, although clearly you can see early innings, it's having an impact on things like housing.